Howdy, everybody. Welcome to Liberty Call. Today is Friday, August 9th, 2024. Hope you're having a fantastical day out there. It's kind of gloomy here in Colorado. As you can tell, it's not very bright here in my office today. It is raining all day, which, again, we're not going to complain after all the forest fires and everything we had the last couple of weeks, so we will take it. Anyways, and I've had a terrible headache. Feels like my brain is trying to push through my skull, so something about the high to low pressure or low pressure to high pressure, it's quite painful. So my brain or my sinuses are like a barometer. So I guess I could have been a weatherman in a previous life before technology. So anyways, if it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, a like, share, subscribe, follow, and press the notification bell. Looks like the market's finished in a decent mood. Certainly not, jumping through the roof or anything today. So let's go ahead and jump over and take a peek. Dow Jones was up 0.13%, 51 points. Closed at 39,497. The S&P 500 up 0.47%, 24 points. Closed at 53,444. NASDAQ up 0.51%, 85 points. Closed at 16,745. The VIX fell 14.38% today. It's back down to 2037. Canada up 0.39. Brazil up 1.42%. And Mexico up a third. In Europe, Germany was up 0.24%, the UK up 0.28%, France up 0.31%, Netherlands down 0.13%, Spain up 0.76%, Italy up 0.13%, Switzerland up 0.41%, and Portugal down 0.29%. Russian exchanges both red again today. The MOEX down 0.23%, same with the RTSI. And the Asian markets, the Nikkei in Japan was up 0.74%, Australia up 1.25%. New Zealand up 0.18%. In China, the Shanghai was down 0.27%. The Shenzhen component down 0.62%. China A50 up a tenth. DJ Shanghai down 0.38%. Hang Seng up 1.17%. And the Taiwan weighted when it closed on the 8th was down 2% even. All right. You can see Jake back there. He is excited. Can you tell he's on the edge of the floor, just hanging on with his claws? Alrighty, let's bring up the weekly chart. Let's get all the crap off the screen. 1 week, starting out with the Dow Jones. Alrighty, so it's going to start the week off. It's going to finish off down about 0.35%. So, I mean, you can see the massive jump that it had from last week. Oops. Wrong button. Last week to the start of the week, it was down almost 3% at the open on Monday. So that was a big jump. So S&P 500, it's going to finish the week pretty flat. Looks like it's down 0.03. The NASDAQ, it's going to finish the week off down about 0.11. The Dow Transports finished the week down about 0.31, and the Dow Utilities going to finish the week down about 2.17%. So that's the one big one right there. So anyway, so those are our charts for the week. Let me put that back. So on Monday, I know what I'm looking at, and go back to the Dow 30. All right, that's off the screen. Terrific, terrific, terrific. So all that gyrations we had, starting last Friday and through, the early part of this week kind of ended up right back in the same place. So it's, I don't think everything is back exactly, but, certainly not terrible. All right, let's get into the economic data for the week. U.S. Initial jobless claims came in at 233,000. Forecast was 241. Previous week was 250. So that was some improvement. Continuing claims came in at 1.875 million. Forecast was 1.87, so 5,000 over forecast. Previous number was 1.869. The ISM Non-Manufacturing Purchasing Managers Index came in at 51.4, right on forecast. Previous number was a 48.8. The trade balance came in at a deficit of 73.1. And forecast was 72.5, so a little worse than forecast. Previous number was 75. Federal Reserve balance sheet currently is sitting at $7.175 trillion. The previous number was $7.178 trillion. So we lost, what was that? About $3 billion came off of that in the last week. So, all right. So that is all the data for the week. It was a light week on, data coming out. So we'll go ahead and get on over to the market recap for today. S&P 500 rises as tech leads recovery after a tumultuous, easy for you to say, week. All right. A year ago, we highlighted specific revisions made by the Energy Information Agency, the statistical arm of Biden's. Hang on. Is this the right article? No, this is not. This is not the right article. Hang on. Let me get back to where I should be. I must have copied and pasted the wrong stuff. All right. Hang on. Just a second. Just a second. There we are. I must have forgotten to copy and paste it over. So, be just a second. You can look at my smiling face. I can't see you because I'm watching this at the moment. So, all righty. Here we go. Copy. Come back over here and erase that. Looks like that was part of yesterday's news. All right. Now we're back to it. Get back to my screen. So, hey, there's me. Hey. And Jake is passed out behind me. All right. The S&P 500 closed higher on Friday, led by gains in tech stocks as the market recovered from a significant sell-off earlier in the week, triggered by recession fears. The focus now shifts to the upcoming consumer price index inflation data, which is anticipated to provide further evidence of easing inflation in the U.S. This data is crucial as it could bolster the Federal Reserve's confidence in starting cuts to interest rates as early as September. Traders are increasingly betting on a more aggressive rate cut, with the CME Fed Watch showing expectations of a 50 basis point cut next month compared to earlier predictions of a 25 basis point cut reduction. The shift in sentiment follows a week of volatile trading where concerns about imminent recession led to heightened market anxiety. On the corporate front, Paramount Global stock rose by 0.9% after the entertainment giant exceeded profit expectations and reported its streaming business's first quarterly profit in 3 years. Wow, congratulations there. The company also announced it would cut 15% of its U.S. workforce to reduce costs. Probably a smart idea. UBS noted that while Paramount TV's media division might face challenges in the third quarter, the fourth quarter could benefit from sports, political content, and licensing. Yeah, well, with politics, that always seems to drive ratings. So, Expedia's shares surged over 10%, following its better-than-expected quarterly results, despite warning of softening travel demand in July. However, Array Technologies saw its stock plummet over 19% after lowering its annual guidance, and Elf Beauty stock dropped over 21%, despite raising its annual sales and profit forecast as its cautious outlook spooked investors. All right, so like I said, it's kind of a light day in the market. It's not. It's been kind of a gloomy day here and kind of a gloomy day across the globe. So, all righty, let's get on over to our next article here. This one is from Investopedia's Newswire. Fed official says economy is showing strength. No need to rush interest rate cuts. I'm sure that makes people thrilled who've been out there waiting for the Fed to cut rates, which, I mean, since they started raising rates, when was that, March, April of 22? I remember I was sitting in New Hampshire in like the summer of 2 years ago and talking about this and reading articles about, well, when they lower rates. It's like, what? It's like inflation's still climbing and you're already talking about when you're going to lower rates. It just seems a little premature. All right, let's dive into this. Faced with ongoing inflation and a strong labor market, Federal Reserve official Tom Barkin emphasized that the central bank has time to assess economic conditions before deciding to cut interest rates. During a National Association of Business Economists webcast on Thursday, the Richmond Fed president highlighted that The current economic strength does not justify an immediate rate cut. Barkin's comments come in the wake of a disappointing jobs report, which prompted market speculation about whether the Fed should act more aggressively to lower rates. Last week, the Fed chose to keep the federal funds rate at its highest level since 2001, but Fed Chair Jerome Powell hinted that policy easing could begin as early as September. Barkin outlined two scenarios that would necessitate rapid rate cuts: a sudden spike in unemployment or a swift decline in inflation. However, he noted that neither situation was currently unfolding. While recent inflation data has shown improvement with price pressures easing across more sectors of the economy, Barkin cautioned that inflation is not expected to drop significantly from current levels throughout the rest of the year. Addressing labor market conditions, Barkin observed that businesses in his district are becoming more cautious with hiring, but are not resorting to layoffs. He suggested that the Fed has room to see more, and that's in quotes, in terms of both labor and inflation data before making any decisions. Looking ahead, Barkin pointed out that the Fed will receive additional economic data before its next meeting on September 17th and 18th. He expressed confidence in taking the time to analyze this data before considering any changes to monetary policy. So, well, that's good news that they're actually paying attention to what's going on and not just willy-nilly, Well, if you've ever seen the South Park episode, Margaritaville, where, they basically explain the financial meltdown that caused all the problems back in 2008 and 2009. And, was it Stan? He goes to the Federal Reserve to return his dad's margarita machine that he had financed. And, when he goes inside, how they make decisions is they cut the head off a chicken and they throw it into this pit, and wherever it lands, once it dies, if it's like a bailout or whatever it might be, that's what they do. So it was kind of funny. I doubt they actually do that, but it was still a little hilarious. All right. One last article here comes from our friends over at the Mises Wire. Money supply growth accelerates as Wall Street demands even more easy money. And we've been talking about how the Fed has been reducing the money supply, the M2, from the time that it peaked out at, I think, at about 22 trillion, I believe. It's come down about $1.5 trillion since it peaked out. But this year, I think it was up about 0.8% last I looked. So it is starting to climb again. So let's go ahead and dive into this. All right. In June, U.S. money supply growth rose year over year for the second consecutive month, marking the first such increases since October of 22. The shift suggests a potential stabilization in the money supply after a prolonged period of significant contraction through 23 and 2024. I don't know if I'd call it significant contraction. It was an itsy bitsy amount. In June, the money supply grew by over 0.24% year over year, matching May's increase and reversing the sharp 12.5% decline seen in June of 23. Month to month, the money supply was nearly flat, rising at just 0.002% from May to June. This recent trend hints at either a flat or gradually upward trajectory in money supply growth. The metric used to track this growth, known as the True or Rothbard-Salerno money supply measure, the TMS, indicates that while the money supply has rebounded, it remains well above levels from 1989 to 2009. To return to that historical trend, the money supply would need to decrease by approximately $3 trillion, a daunting prospect given the current economic climate. The persistent overhang from years of rapid money supply expansion is contributing to economic stagflation. Despite significant drops in the money supply, employment has only stagnated and inflation remains above the Federal Reserve's target rate. The Fed's current approach appears to be a, quote, wait and hope strategy where it maintains steady interest rates while hoping for a natural decrease in Treasury yields without triggering more inflation. The central dilemma for the Fed is balancing Wall Street's demands for lower rates and easy money with the risk of accelerating inflation. While the Fed has historically responded to Wall Street's desires, its current focus is on managing government debt. This balancing act could lead to more price inflation for ordinary people, as the Fed might prioritize keeping borrowing costs low for government over controlling inflation. So again, kind of that, wait and hope or cross your fingers and pray or whatever it might be. I mean, that just seems to be the Fed seems to be more accommodating to Wall Street and big business than it is to, you and I, the little guy. So Anyways, all right. Well, that is everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. Well, you can get all your financial needs taken care of there. Planning for your future, your retirement, whatever it might be. Give me a buzz. I'd be happy to help. All right. Well, like I said, that's everything that I had to cover for today. Hope everyone out there has a wonderful weekend, and hope you get lots of chores and fun stuff done. I'll probably be doing more chores than fun stuff, but is what it is. All right. Well, hope everyone, like I said, has a great weekend, and I'll talk to all y'all again next time. Adios.